For decades, the world's biggest banks secretly rigged the price of money itself. Your mortgage, your debt, your future. It was called LIBOR, the London Interbank Offered Rate. The most powerful number in global finance, and almost no one outside the industry had ever heard of it. It wasn't a stock, a bond, or a government policy. It was the price of money itself. If you love the real stories behind money and power, hit like and subscribe before we go on. Now let's dive in. Each day, major banks Barclays, JP Morgan, Deutsche Bank, UBS, Citigroup were asked one question. If you had to borrow from another big bank today, what rate would they charge you? The highest and lowest answers were thrown out, and the rest averaged. That average became the official LIBOR. Simple, elegant, and catastrophically naive. Because those numbers weren't based on real transactions. They were based on trust, the assumption that trillion-dollar institutions would tell the truth. And in high finance, trust is the easiest thing to weaponize. LIBOR was the benchmark for almost everything over $350 trillion in contracts worldwide. Corporate loans, student loans, mortgages, credit cards, government bonds. When you paid your mortgage, when your student debt accrued another dollar, when nations borrowed from each other, LIBOR was the invisible reference point deciding the cost. Economists called it the world's most important number. And yet this global benchmark was built on nothing more than a few banks guessing what borrowing might cost that day. It was like letting students grade their own exams, then paying them bonuses based on how high they scored. At first it worked. But inside those banks, a quiet realization spread. If a tiny adjustment could move trillions, then whoever influenced that number had power. Real, invisible power. And power in finance is never left unused. So how did they manipulate it?
Imagine a trader holding a massive bet, a derivative that pays off if rates move a certain way. If he knows LIBOR will move tomorrow, he can position his trades to make millions.
But why wait when he can nudge it himself? He messages a friend at the money market desk, the team that submits the daily rate. Hey, can you lowball LIBOR a bit today? The colleague adjusts the number and sends it in. That tiny adjustment shifts the average. LIBOR falls maybe by 1/100%. It doesn't sound like much.
But when trillions in contracts are tied to that number, 1/100% means billions move instantly. And every time the rate moved, the traders who nudged it collected the winnings.
It wasn't complicated. It was subtle. And that made it perfect, because no one was checking. The association that oversaw LIBOR assumed big banks would never lie. Regulators trusted the system. For decades, it seemed to work. Until it didn't. By the early 2000s, quiet manipulation had evolved into open collusion. Traders across continents coordinated in secret chat rooms with names like the cartel and the mafia. Their messages read like a heist movie written by teenagers. Can you move 3-month LIBOR down a tick today? Sure, mate. You owe me a bottle. They joked about fixing the fix, sent each other champagne and Wimbledon tickets, all while moving billions that affected everything from pensions to family mortgages. By 2007, the housing market was cracking, and LIBOR, the number meant to measure trust between banks, became fiction. When the crisis hit in 2008, banks didn't trust each other enough to lend, but didn't want to show it, so they reported lower borrowing rates, pretending they were healthy and stable. In reality, the interbank market had frozen. LIBOR, one economist said, was the thermometer reading 98 degrees while the patient was in cardiac arrest. Banks lied to save face. Regulators looked away to prevent panic. And the world kept using a number that had lost all connection to reality. The index created to measure trust became a symbol of deception. The truth finally surfaced in 2012. It started with Barclays, which admitted to rigging LIBOR and handed over chat transcripts. The tone was astonishing not for what they revealed, but how casual it was. These weren't criminal masterminds. They were ordinary traders joking about distorting the global financial system as if it were a game. When questioned, one Barclays employee famously said, "We all did it," and he wasn't wrong. The scandals spread like wildfire. UBS, Deutsche Bank, JP Morgan, Citigroup, and the Royal Bank of Scotland were all implicated, each manipulating LIBOR to profit from trades. or to look stronger during the crisis. It wasn't one bad actor. It was an entire system incentivized to cheat. By the time the dust settled, the fines reached nearly $9 billion. Impressive in headlines, but insignificant next to the profits generated. It was the cost of doing business, not a punishment. Just an accounting entry. A few traders were charged, some jailed, but they were scapegoats, the visible tips of an invisible system. The institution survived untouched. Bonuses continued. Within months, business resumed as if nothing had happened, and that was part of the genius. When the crime is too complex to explain in a headline, accountability dissolves into abstraction. Traders didn't need to hack the system. They were the system. Markets move not on morality, but on incentives, and the incentive was always profit. LIBOR wasn't transparent data. It was a survey, a daily poll of bankers filling in blanks however they pleased. Give absolute discretion to profit-driven institutions, and you don't get objectivity, you get choreography. Governments faced a choice: expose the full extent and risk destroying faith in the system, or contain it quietly. They chose containment. LIBOR was retired in 2023, replaced by SOFR, based on real transaction data. In theory, cleaner. In practice, it still depends on the same institutions, the same incentives, and the same culture that made LIBOR possible. The names have changed, the behavior hasn't. Because the LIBOR scandal wasn't really about interest rates. It was about trust, the kind that underpins every financial contract, every central bank decision, every pension fund. The kind that collapses silently, not with explosions, but with emails and percentages no one double-checks. When a banker submits a false rate, he doesn't just change a statistic. He changes the reality millions live in. Higher mortgage payments, tighter credit, deeper national debt. The manipulation wasn't victimless, it was a silent tax on every borrower in the world. And yet it barely made the news, because the victims weren't visible, and the villains wore ties. Just fractions of percentages, invisible but compounding, siphoning wealth from the many to the few. That's the quiet genius of systemic corruption. It hides in order, not chaos. When deception becomes part of the daily process, it stops being seen as crime. It becomes how things work. The LIBOR scandal revealed something uncomfortable. The global financial system isn't built on precision. It's built on confidence, the belief that everyone is playing fair. The price of money isn't just a statistic. It's a story about who decides, who benefits, and who believes. LIBOR's fall was a reminder that the people who control the world's money don't need to break the rules. They just need to write them. And maybe the most unsettling truth is this: the manipulation never really stopped. It just evolved, buried under new acronyms, new regulations, new benchmarks. The names change. The profits remain. The cycle continues. Thank you for watching all the way to the end. If this gave you a new perspective on how money and power really work, hit like and subscribe, because history always has the answers. You just have to know where to look.